Well, with U.S. inflation slowing more than expected in October, markets are heading higher on hopes that the Fed will not need to raise interest rates again next month. Our next guest says investors should focus on when the Fed will start cutting rates rather than how many rate cuts it will deliver. For more perspective, joining us now is Neil Dutta, partner and head of economic research at Renaissance Macro Research. Neil, thanks so much for joining us this afternoon.
Thank you.
So what do you make of the inflation data? It seems like markets are making a lot out of it, yet, I mean, it came in slightly lower than expected. But when you're looking at that core inflation coming in at 4%, that's still double the Fed's target.
Well, I think, markets have a tendency of overreacting to one data point here and there. That's true. But I think what's important to note is that the trend in inflation is pointing to much weaker inflation rates over the next several months. I mean, the fact that core inflation rose just 0.2%, that happened despite a very modest decline in used car prices. We know that that's likely to continue. We know that shelter or housing rental inflation will continue to decelerate given what we're seeing in market-based rents. We know that, goods outside of cars will probably ease somewhat as well. So there's good reason to think that that inflation will continue to moderate from here. And we also know that, if anything, core CPI is overstated somewhat because medical care services inflation was a bit firmer, and that's unlikely to repeat again, that swing. But more importantly, that doesn't really feed into the Fed's preferred measure of inflation, which is the PCE price index. So I do think that the doves on the FOMC have basically everything they need to not only call off the hike in December. I mean, I think that's easy. But I think this opens the door at this point for them cutting a little bit sooner than markets anticipate.
So how soon do you think they would consider cutting then, Neil?
I don't think you can rule out a March rate cut. When you think about the unemployment rate as an example, the unemployment rate is up to 3.9%, as we know. And that's about a little over where the Fed has it for the year. That's the first time the unemployment rate's actually gone above the Fed's year-end forecast since March of 2022. So I think that's notable. But I do think the doves, with the rise in unemployment, with the slowing in wage growth, they can basically say that the labor markets have largely rebalanced. That seems to be the message in the JOLTS data as well. So that's important because that means that the hawks can no longer use the labor market as a rationale to stay hawkish. And the inflation data are continuing to cooperate. So if you think about sort of a rules-based type of framework where you relate changes in the unemployment rate and consumer prices into Fed funds expectations, we're basically right there. The Fed's where it needs to be. And if inflation continues to cool, then you can justify cuts. And so that's all I'm really saying. And I know that comes as a surprise because obviously the Fed's rhetoric has been hawkish. But I also think it's important for investors to remember that Jerome Powell has been, at times, very willing to do a rug pull. Sort of, if you think about 2018, we're a long way from neutral, and then he's cutting a few months later. We're not even thinking about rate hikes or tapering. And lo and behold, they're tapering and raising rates in the same month, or, at one point, no one thought they would go 75, and that's exactly what they ended up doing for several consecutive meetings. So just because the Fed's not talking about it right now doesn't mean they can't shift their views later.
Yeah, it is interesting because the messaging hasn't been as confident as yours, with Powell most recently saying that he isn't confident that they've done enough to get inflation down to the target. And then we heard from a couple Fed speakers today talking about a bumpy road to get to that 2% inflation target. But could that still be the case? Could it still be a bumpy road to get to that 2% target, not necessarily straight from here to 2?
Yeah, sure, it can be bumpy. You can never rule out a data surprise here and there. But I mean, think about the overarching trajectory right now of inflation. I mean, core inflation is basically running 2.5% over the last several months at an annual rate. And the unemployment rate is 3.9%. I mean, that's half a point up from its lows. If you go back and check the historical record, I mean, the Fed has at times before cut in that kind of a situation. Now, I don't expect them to cut sharply, aggressively. I mean, we're talking about a recalibration of policy, not unlike what we saw in 1995. But this sort of idea that things are going to be bumpy, I almost feel like that's something the Fed has to say because they've been on the wrong side of the inflation story for a while. But when I look at the data, I think that there's a decent pipeline of disinflation on the horizon. And my sense is that there's room for continued slippage of core inflation. I think that'll give the Fed a lot of confidence to begin cutting rates surgically. Not aggressively, but I certainly think that the Fed can think about cutting rates several times next year.
When we're looking at the market reaction today, too, looking at Treasury yields easing, slipping, does that make the Fed's job more difficult, do you think?
Well, I think what that market reaction tells me is that there's probably a ceiling on how many cuts the Fed can do. It doesn't mean that they can't cut, but it just keeps a ceiling on how much they can do. If you think about the Fed's reaction function as sort of three things, right? It's the labor markets, it's inflation, and then it's financial market conditions. As I mentioned, I think the unemployment rate situation is basically a check mark. They can say that the labor markets have rebalanced. Because of that, they can show increased confidence that inflation will continue to move towards their goals. Remember, the Fed has very much a labor market-centric view of how the inflation process works, and the fact that labor markets are rebalancing, that should give them confidence that the disinflation trend that we've seen towards their longer-run objective will sustain, and then and that allows them to basically essentially underwrite this easing of financial market conditions. I mean, it would be one thing if the labor markets were still super tight and wages were very strong. Then they'd be a little bit more concerned about what's going on with financial market conditions. But the fact that inflation is cooled and the labor markets have rebalanced, I think that allows them to kind of turn the other cheek with respect to what's going on with financial markets. So that, to me, that's sort of a green light for risk assets for the next few months.
Okay.